What's up, guys? It's Eric. I want to do a quick video for you guys. Sometimes I, uh, I think it's a crazy question, or it's hard to compare when somebody asks a question like, or they say something like, "Well, I don't think it's worth it if I can't make, if I can make $100,000 a year as an employee driving truck. Why would I be an owner operator for 150,000?" And they always say like the word like take home pay. If I can't make 100,000 take home, or if I can't make 50,000 take home, you can switch the number wherever you want it to be. But basically, it's this the word that I have the issue with is take home. And so my wife does a lot of we have a couple office employees, and she manages the office employees, and I do like kind of like getting the work, bidding the work, dealing with the drivers, driving myself, maintenance stuff. So to talk to you guys about taxes is honestly more out of my depth, and I should have her here with me, but I don't have her with me. I just wanted to kind of touch on this and explain it. So I think it's worth talking about, and I can go more in depth if there's a need or whatnot. But the main thing is that when you have a business, your goal is to disperse your income into things that you can write off as much as possible. And when you are an employee, your goal is to make as much money as possible. So what I mean by that is, as an employee, you get paid, and what comes out is your taxes. And then after, so they call that take home. So like after you pay your taxes, you get a check, and that's when you see your money. Well, when you own a business, not just a trucking business, but any business, you get paid before the government takes taxes out. So basically the goal is to spend your money in ways that you can write things off, so that when it comes to tax season, it shows that you didn't make as much money, meaning that your take-home pay would be less. But like, so some things that, some examples that I want to give you, I have them written down, is like, I'm sure you guys have heard this stuff before, but like, so like, if you go to a job, things that you have to do after you've been taxed is, you've got to, basically, you don't have to have any of this stuff, but chances are you do, so like, once in a while you're going to want to take a trip. Once in a while you're probably going to have a cell phone, or just a phone in your house, or a computer, or TVs, or cable internet, and you're more than likely going to buy vehicles, or like a boat, or like season tickets to your favorite sports team or something like that, right? So like, all that stuff as an employee, once you get your check, let's say you make $5,000 a month, what is it, take home. So you're seeing a check for $5,000. So then you go through and you say, okay, so I have $500 car payment that I'm taking out of that. So now it drops me down to $4,500. I'm saving for a trip. So I'm saving $1,000 a month. So now I'm at $3,500. I have a boat, and I have a $500 payment on that. So now I'm at $3,000. And then you have season tickets, and I have no clue what those cost. But so you have season tickets, and let's just say that's $1,000 a month. So you're $2,500 after you've spent all that stuff, but you've paid taxes on everything already. But with owning a business and not paying taxes till the end of the year, what you would do is you would talk to your accountant, and you would say, if I'm planning a trip, how can I write some of it off or all of it off? And he would say, well, if it's, whatever he or she would say. But the point is you would want to talk to your accountant about all this stuff, but that it's worth talking to him about it. So then you would say, okay, I figured out a way to do that, or he explained how you could do it. The trip was $10,000, you made $150,000, or that's what you grossed for the year. You take that $10,000 right off the top of your $140,000, so now you're down to, you only made $140 for the year, so now you only have to pay taxes on $140. Well, then you also have a fancy 1-ton like Denali, just super sweet pickup truck, and you bought that in your business because you need a Denali pickup truck to run your business. So now you do that, and you can't use that truck without putting fuel in it, because you got to run your business, you need to go places, and you need to do things. So let's just say you deduct, I think there's ways that you can deduct the whole thing in 1 year if you needed the deduction. So like $80,000. Let's just say you could. Okay, so don't take this to the bank. You got to talk to somebody that actually knows. But let's just say you bought a very practical $80,000 Denali 1-ton pickup truck because you need it to run your business. And then also you probably need like a $10,000, $20,000 enclosed trailer to run your business that you can also use to haul your Harleys around as well. So now you've now deducted $100,000 for the truck, $100,000 with the truck and the trailer. That brings your gross down to, now you've only made, so you had the $10,000 trip and $100,000. We started at $150 is what you grossed. So that would mean you are down to only producing your take home as $50,000. Okay, so now the question is what other things do you want to write off? Your cell phone, you need it to run your business, so that's something you can write off. Like these people that have these huge yachts and stuff like that. I mean, you need a yacht because you need to take business people out on the yacht and have corporate functions and networking events, and it's a practical way of running a business, so you need that. Someone like myself, I need a fishing boat, so that, because in the trucking industry there's lots of real just blue collar guys, and a good way of creating relationships is taking clients out fishing. Another way is you need season tickets to create relationships and meet new people for your business, to grow your business. So the whole point is that if you can figure out a way to write off things that you already are going to buy anyways, it brings your take-home pay down. So then the only expenses you have are like, renting your house or buying your house, which, you can still write off some of that. But there's some things that you probably can't write off. But what I'm trying to get you guys to understand is that, and the problem with me trying to explain it is I don't have all the technicalities down. I just know, I'm just trying to introduce you to the general way of thinking, and how it's backwards and unfair to basically go into something thinking, well, if I can't make 80,000 take home, it's not worth it. Or, this is the reason why farmers, they don't ever make any money. Or, it's the same thing. You buy things, you get into something that you like, and that you can take advantage of writing things off, and that clears out your profits. But they're actually really there. It's just, you can actually spend money on things that you want already or need and write them off, and you get to basically erase your earnings. So I think that I did it justice. I know it wasn't perfect, so don't whatever, be easy on me. Thanks, guys.